Welcome to Matco's quarterly update. Investment markets started off the year following a Dr. Jekyll and Mr. Hyde trajectory. January brought the smoother sailing markets of Dr. Jekyll, February was uneventful, and the markets of turbulent Mr. Hyde emerged in March. The themes driving these contrasting trajectories, which we will touch on shortly, may sound familiar if you did have a chance to watch our annual outlook for 2023, released earlier this year. So let's start with the developments that were aligned with our annual outlook. First off, zero corporate earnings growth. Through January and February, companies in North America reported their corporate updates, in which we get a chance to see if they are continuing to grow their profits. In Canada, broadly speaking, corporate earnings growth across all companies in the S&P/TSX saw profits decline by 1.1%. This contrasts with earnings that grew by 22% through 2022, a stark and noticeable decline. This did not come as a surprise for us at Matco. Our expectation was for a meager 6% in earnings growth for this year, almost all of which is expected to be realized in the second half of the year. Secondly, central banks moving to the sidelines. Throughout 2022, the Bank of Canada and the US dramatically ran up interest rates by approximately 4.5%. However, our expectation was for both central banks to pause their rate increases by the end of the first quarter. The Bank of Canada did in fact pause their interest rate increases in the month of March. The US reduced their run pace to a crawl in March with a small increase of 0.25%, and they are expected to move to the sidelines after one more increase of the same 0.25%. Now thirdly, valuation multiples expanding. Although corporate profit growth was non-existent through the first quarter, central banks no longer increasing interest rates in dramatic fashion has been well received by markets. Financial conditions may be tight, but not getting tighter has allowed valuation multiples to expand and grow. In simpler terms, this means stock prices have been able to grind higher, which occurred primarily through the month of January despite the lack of corporate profit growth. As mentioned, those three themes fall in line with our expectations of our 2023 annual outlook. The list of themes misaligned with our outlook is shorter, but still meaningful. That would be the emergence of a banking crisis. In mid-March, Silicon Valley Bank, or SVB, faced a run on its deposits, forcing the bank into receivership or default. Other banks, such as Credit Suisse, First Republic Bank, and even Pacific Western Bank have been under similar pressure. SVB has since been acquired by First Citizens Bank, and Credit Suisse has been purchased by UBS. These acquisitions have helped lessen the financial system stress. More critically, the US federal government has put measures in place to safeguard the deposits of banks beyond the typical $250,000 covered by deposit insurance. These things in combination have staved off a run on banks by depositors while providing reinforcement and confidence that the banking crisis would not spread beyond a select few banks. Although markets had held on to their gains through February, the increased stress on the financial system from these particular events caused markets to give up most of their gains year to date in the month of March. The developments in the banking sector have started to highlight the economic implications of increasing interest rates. Now that recaps the primary developments of the first quarter, but where to from here? Despite both the aligned and misaligned developments during the first quarter, the broader economy remains in healthy shape. The labor market has continued to show resilience. Canadian and US unemployment rates have moved lower by about 2% to 4% over the last 2 years and remain stable at low levels. We have observed some layoffs, particularly in the technology sector. However, widespread layoffs have not taken place, as evidenced by the continuing decline of the initial jobless claims indicator. Inflation, the market's primary headwind throughout last year, continues to grind lower, albeit at a slower pace than desired. Global industrial production has also picked up, a result of the loosening COVID policy constraints in China. And lastly, consumer sentiment has improved materially over the last 6 months. All in all, broad economic fundamentals are intact. Looking out to the remainder of the year, we expect markets to continue to grind higher through the second quarter, while volatility is likely to reemerge in the second half of the year, creating a challenging environment for markets to hold on to their gains. What has all this meant for Matco's investment platform? Matco's Balanced Fund is a multi-asset class portfolio with exposure to fixed income, Canadian, and global equities. The oversight of the fund's investment mix is actively managed by our Asset Mix Committee. Our primary risk tool, the Investment Horizon Indicator, increased from the neutral zone and moved closer to the protect zone in January. Approaching the protect zone indicates, from a risk management perspective, the fund's investment mix should prioritize protection of capital. As a result, the Asset Mix Committee made an active adjustment by decreasing the fund's global equity exposure by 5%, while increasing its fixed income exposure by the same 5%. This will offer the fund a greater level of income while providing more protection as the economy decelerates. The fund is up 3.2% year to date.
Macro Canadian Equity Fund invests in mid to large cap dividend paying companies and is diversified across a number of sectors. During the first quarter of 2023, the fund increased its materials and industrial sector weights. The fund's two largest sector exposures currently are financials at 29% and industrials at 24%. In terms of resource exposure, the fund has 11% in energy and 5% in materials. Year to date, the fund is up 4% and has an annualized 17.5% return over the last 3 years. Currently, the fund has a dividend yield of 3.75%. Now, recently, one of our holdings, TD Bank, has been in the headlines due to concerns that they're overpaying for First Horizon Bank in the United States. TD may renegotiate a lower price given the uncertainty regarding the U.S. regional banking sector. However, even if they do not renegotiate a lower price, we think that TD Bank is still a good investment for long-term investors, and we're not concerned about it in the long run. Since, like other Canadian banks, they have a strong balance sheet and excess capital to withstand any concerns about banking crisis in Canada.
The Matco Global Equity Fund is constructed with a well-diversified combination of publicly traded stocks. It provides clients with exposure to U.S., international, and emerging markets. With a growth and a reasonable price investment strategy, the fund's goal is to deliver long-term capital appreciation for investors. So what's happened so far? Well, over the first quarter of 2023, the fund trimmed positions in U.S., Japanese, and emerging market securities while adding to Europe. Developments in the global financial sector presented a challenge to broad markets during the period. However, due to the fund's investment process, there was no direct exposure to the problematic U.S. banks. As of March 31st, 2023, the fund has returned 5% year to date and an annualized 13.8% each year over the last 3 years.
I'm here to talk about the Matco Small Cap Fund. This fund invests in smaller dividend-paying companies that are typically growing faster than the economy. During the first quarter of 2023, the fund increased its weight in energy and the consumer discretionary sectors and reduced its technology weight. The reason why we reduced our weight in technology is that one of our companies was taken private with an 80% gain in the portfolio. So we were very happy about that. Now today, or at the end of March, the fund's two largest sector exposures are energy at 24% and financials at 21%. So big weights in a small cap portfolio. Year to date, the fund is slightly down at 0.5%, but has an annualized 3-year return of 15.7% every year for the last 3 years. Now the fund is very attractive in terms of dividend yield, has a dividend yield over 5%.
Matco's fixed income fund is a portfolio constructed of Canadian investment grade bonds with the sole focus of preserving capital while generating income. The fund employs a multi-strategy approach optimizing its interest rate exposure, credit, and yield curve exposures. Given the more attractive yields offered in the marketplace, coupled with the prospect of central banks reaching the end of the interest rate increase cycle, the fund extended its duration or interest rate sensitivity by 0.25 years in the first quarter. The fund's current duration is 7.4 years, with a current yield of 3.3% and a yield to maturity of 4.2%. Overall, the fund is currently positioned to generate healthy income over the next 12 months with the capacity to provide capital appreciation if and when interest rates do decrease, potentially in 2024.